Hello, this is Trading with Confidence, and I'm John Breland. So today I'm going to talk about candlestick charts, and I'm also going to interpret volume so you can understand what volume is telling you about the markets. Let's get started. Okay, so here we have a chart of Bitcoin price and volume. So I have it set to candlesticks to show the price action, but there are various different ways to show price. If you go to Trading View, you'll see there's a conventional bar depiction. There is a line which plots the closes of each bar pretty much. There's this baseline which we see in like CoinMarketCap and other online sites. We have Heikin-Ashi, which is an interesting way to show a price. So I want to separate two screens here. I'll show one with candles and one versus Heikin-Ashi. So Heikin-Ashi looks like candlesticks, and you can see that the Heikin-Ashi cleaned out a lot of the noise here. In some of these really choppy areas, it doesn't do a great job with noise, but it does what it can do. Some people like to trade this. I like to see the real price in front of me. So this being synthesized, these open values aren't necessarily correct. Like you'll see down here, the open value of this particular bar is right there, but on the Heikin-Ashi chart, it's right there. But on the real chart, you can see up here it's a bit higher. This one's pretty far away here. This open is showing at this level here, but this opens way up here. So I mean, you don't necessarily get the best fills when using Heikin-Ashi, because it's synthesized. It's you don't really know exactly where the market is, but it does a pretty good job of trying to define trends. You can get caught in these areas here where you think, okay, now the green is going to start. Well, then it just turned right back to red. So you know, it has its flaws, but it's definitely an interesting way to show price. So then there are other ways, like these ones down here are not, they don't include time in their analysis. So this is only if the bar moves up to or the price moves up to a new level, then it draws a new box. And so it attempts to remove the noise as well. Of course, you get these periods here where there's a blip, so to speak. These other charts show the similar method of not including time, and they try to these bars don't happen like once per day, for example, or once per minute, or whatever you have it set to. It's just as the price moves, it begins to draw. So I don't really use these because in my analysis, I use time in my analysis. That's a very important part of my analysis. So I pretty much stick to candles. So candlesticks are drawn based on, well, let me just describe it this way. This is called a candlesticks cheat sheet. And you can see that in a bearish move, the candle is red, and the open is at the top of the candle, the close is at the bottom of the candle, and the highest price was at the upper wick, and the lowest price is on the lower wick. For a bullish move, the open is at the bottom of the candle, the close is at the top of the candle. Again, the highest price is at the top of the wick, and the lowest price is at the bottom of the wick. They also offer these patterns to help you determine if you're in a bullish trend or a bearish trend, and typically these patterns have to exist after the full pattern is complete. So for example, if you saw a pattern like this hammer or inverted hammer, and you saw two bars after that, well, then that would be a reversal signal, and you would get in after that bar. Likewise, with the short side, You have like what they call like an evening star, which is similar to a hammer. It's just smaller. The wicks are smaller. You have this bearish engulfing, which is similar to this bullish engulfing here. For the bullish, you call it a morning star. For the bearish, they call it an evening star. So it's all really interesting way of looking at the markets. Of course, if you have also these very strong moves in the opposite direction, these are considered bullish and bearish signals. And so if you go back to the markets, you'll see that, here we have, for example, an evening star, and you see the market go down after that evening star. So this is the beginning of a bear here. Here's a bearish engulfing. So let me see if I can blow this up a little bit. Bearish engulfing right there, and so that would indicate a move down. You get in like somewhere down here. A bullish engulfing, this is probably a bullish engulfing. So yeah, they appear in the market, and it's an interesting way to validate your trades. So any way that can be helpful to validate is a good thing. Here's a bullish hammer signal right here. We got some bull move up to resistance right here. So one thing I do want to mention about candlesticks is that I often see a pattern where if there is a very large move down on a particular day and it bounces, so you get this very large wick here, that the target of the market can be at that wick spot. So for example, so the target of the wick is here, right? I mean, it went down to this level, and then it bounced. So these are often good future market targets. As you can see, I mean, this went in almost vertical. I mean, this is pretty much vertical here, and it bounced because it was just too low. I mean, this bar was huge, and so a lot of traders took the opportunity to buy it up. And but what happens is that this ends up being a future target. So when you see something like this and the market comes up, it's not a bad idea to consider taking a short trade and waiting for it to hit the target. So this happened right here. This pretty large wick, it finally hit that target. Happened right over here. Large wick finally hits the target down here. Here's another example of a large wick. You see this large wick here, sell it, and it reaches the target. So it sometimes happens on the upside too. Kind of an extreme wick, comes back down, then you buy it, and it reaches that target. It's not a bad way, not that bad way to go. Here was a relatively large wick compared to the body. It came close to the target, pretty close to the target right there. So, but you don't want to confuse that with these kinds of wicks where they're really not very large in comparison with the rest of the market. I mean, you can see these bodies are about this size or so, and this wick is a little bit smaller. But in this case, I mean, this wick is, compared to the rest of the market action, this wick is huge. Yeah, we had a large one here, but this wick down here is really large compared to the rest of the market movement. See, and I haven't heard too many people talk about it, so that's why I'm talking about it. Okay. So next I want to talk about volume, and volume is really interesting. In this particular chart, I see two basic things. I see a large amount of volume here, and then a relatively smaller amount of volume here. So this market was moving up pretty well until May of 2021, where it just surprised everybody with this crash. And I think that's one of the reasons that it scared a lot of people out of the market. So when we got to this phase with a lower volume, it's because of this crash here that kind of put in some psychological damage into the minds of retail. And so they said, I don't know if I want to do this anymore, kind of thing, right? So a lot of them got out, and so we had less volume. So one interesting thing that you notice about volume is that you've got these large spikes that occur every once in a while. Large spike there, large spike here, there. So what's happening with these large spikes, especially these red spikes, is you get a these are like high fear areas and high action areas. So as the market is moving up, I mean, imagine you don't see this area over here. As the market is moving up, there hasn't been too much of a pullback all the way along here. These little red candles, not so much. But here we had a third red candle. This day scared a lot of people out of crypto. You see that it moved from about 42 down to 37. That's a pretty significant move at that time. So what's happening, it's interesting, what's happening is a lot of the retail traders don't trust it anymore. So they want to get out. They want to take their profits because they see it starting going down. But nobody knows what's really going to happen in the future. So you have the people that are just, they want to take their money, so they get out of the trades. Then you have the people that believe in Bitcoin and know that trading tips is a good strategy, and they take the other side of the trade down here. So that's why you get this large spike. You get a transfer of wealth between retail and wholesale, for lack of a better way to say it. I mean, or you can say that transfer wealth from newer traders to more experienced traders and more well-capitalized traders. That's what's going on here. So you see that also happening here. You had a large spike down, the transfer of money into the hands of experienced traders. Start to see that right here. That was a pretty large move. This one move took out weeks of action. At least, looks like at least 2 to 3 weeks of action went one day. So, these things do happen. Large volume spike here. So these volume spikes are very, very important to notice. Here, just recently, we got 2 volume spikes in a row, which it can be considered as to be one large volume spike. Then you have these volume spikes that are bullish. Here we had a volume spike, and this was because a lot of traders saw a new high being made, and they rushed into the market to take advantage of this upper move, this expected upper move. But because there was a rush of traders buying, there was also people trying to get out of their positions here. And there was also, since there was a glut of buyers, there were temporarily more sellers in the market at the time, and it brought the price back down again. But so every once in a while you get these bullish moves, because there's just a lot of expectation in the market at the time of that this happened. So I mean, you can kind of expect that, because as the market's moving up, this is the first significant pullback, but it's only the first pullback. The market generally experiences more than one pullback on its way up. So that's why there was a lot of enthusiasm here, and a high volume spike. You can see these high volume spikes as well, like for example right here, when the market made a new high. Here was a high, the market shot up and making a new high. So we saw volume move up. A lot of people taking these trades here. So last thing I want to mention about volume is sometimes you can tell with volume which direction the market is going. So if you look at, for example, this time period here, you can, right here we had pretty higher volume than the green volume. Higher red, lower green, higher higher red, lower green. Green started to move up a little bit here, but you'll see here we have higher red, lower green, higher red, lower green. So sometimes you can tell what the market is doing by looking at the particular cycles and looking at volume to see if volume is supporting the move. So if we're seeing like high volume come in, now we're starting to see there is higher red volume than there is green volume, but this is starting to look like it could possibly turn around. Hard to say because right now literally this is lower volume still on the bullish side than on the bearish side. So we have yet to see another bearish move down right now. We'll see what the volume looks like, but you can sometimes tell the direction of the market just by simply looking at what volume is doing. That's a very interesting way to consider, you know, what the trend is. So that's all I have for price and volume. If you got something out of this video, please like and subscribe, and I'll see you on the next video. Thank you.